October 1907, the corner of Madison Avenue and 36th Street, New York City. J.P. Morgan, 70 years old, the most powerful private citizen in America, stands at the door of his private library. His face is granite. His eyes are cold. Outside, the world is ending. Banks are failing across the city. The Knickerbocker Trust Company collapsed 3 days ago. Depositors lined up for blocks, demanding their money. There wasn't enough. The Trust Company of America is next, then the Lincoln Trust, then a dozen more. The stock market has crashed 50% in 3 weeks. Trading has nearly stopped because no one will lend money at any price. Morgan unlocks the library door. Inside, the most powerful bankers in America are waiting. They've been summoned. They didn't have a choice. Morgan controls more capital than most nations. When he calls, you answer. He surveys the room. These men run the banks that run the country. And tonight, they're terrified. Morgan speaks slowly, deliberately. The situation is simple. Either the bankers in this room contribute to a bailout fund immediately, or the entire American financial system collapses by morning. There is no government to save them. There is no central bank. There is only this room. The bankers have until dawn to decide. They contribute, every single one. Some willingly, some under Morgan's withering glare. Over the next 3 weeks, Morgan personally directs the rescue. He examines bank balance sheets at his dining table. He decides which institutions survive and which are allowed to fail. He moves millions with handwritten notes. He becomes, for 21 days, the de facto central bank of the United States of America. One man, unelected, unaccountable, answering to no one, controlling the money supply of a nation of 90 million people. And here's what the textbooks never explain. Morgan didn't save the system out of patriotism. He saved it because he and his associates owned the system. A total collapse would destroy their wealth. So he intervened, stabilized the panic, and emerged more powerful than before. But Morgan was 70 years old. He wouldn't live forever. And he and his fellow bankers understood something crucial. They couldn't rely on one aging tycoon to save them next time. They needed an institution, a permanent solution. A central bank designed by bankers, controlled by bankers, but wrapped in the language of public service so the American people would accept it. 6 years later, they got exactly what they wanted. The Federal Reserve. But Morgan's scheme wasn't original. He was following a pattern that had already played out in England 2 centuries earlier. And it would play out again in Europe a century later. Crisis, panic, secret design, government adoption, permanent wealth extraction. The same 5 stages, the same beneficiaries, the same victims. Let me show you the pattern. Because once you see it, you cannot unsee it. And once you understand it, you'll understand why every dollar you earn has interest attached to it before it even reaches your pocket. Before we examine the historical evidence, you need to understand what a central bank actually is, not the textbook definition, the operational reality. Most people believe central banks are government institutions. They see the Federal Reserve, the Bank of England, the European Central Bank, and they assume these are public agencies like the Treasury or the IRS. They're not. Central banks are hybrids. Private-public partnerships where private banks hold ownership stakes, private bankers sit on governing boards, and private interests shape monetary policy. The government provides the charter and the legal authority. The bankers provide the design and the direction. The Federal Reserve, for example, is owned by its member banks. Private commercial banks purchase stock in their regional Federal Reserve Bank. They elect the majority of directors. The New York Federal Reserve, the most powerful of the 12 regional banks, has always been led by people from the banking industry. The government appoints some officials, but the structure ensures that bankers control the institution that regulates banking. This isn't hidden, it's public information, but no one teaches it in school. Now, what does a central bank actually do? 3 things. First, it creates money. Not by printing physical currency, but by purchasing assets, primarily government bonds, with money that didn't exist before the purchase. When the Federal Reserve buys a treasury bond from a bank, it doesn't transfer existing money. It credits the selling bank's reserve account with new money created from nothing. This is called monetizing debt. The government issues debt. The central bank converts that debt into money, and the debt remains on the central bank's balance sheet, accruing interest paid by taxpayers. Second, A central bank sets interest rates. The federal funds rate, the rate at which banks lend to each other overnight, is set by the Federal Reserve's Open Market Committee. This rate influences every other interest rate in the economy. Mortgages, car loans, credit cards, business loans, all are priced relative to the central bank's target rate. When the Fed raises rates, borrowing becomes expensive. When it lowers rates, borrowing becomes cheap. This gives the central bank enormous power over economic activity, and that power is exercised by appointed officials, not elected representatives. Third, a central bank acts as lender of last resort. When private banks face runs, when they cannot meet depositor demands, the central bank can lend them money to survive. When markets crash, when liquidity evaporates, the central bank can inject funds to keep the system functioning. This sounds like a public service. In practice, it means private losses can be converted into public obligations. Banks take risks. If the risks pay off, banks keep the profits. If the risks fail catastrophically, the central bank intervenes, and ultimately taxpayers absorb the losses. This is the mechanism. Now let me show you the pattern. Every major central bank in history has been created following the same five-stage sequence. Not similar sequences. The same sequence. Stage by stage, century after century. Stage 1. Crisis. A financial panic. A war debt. A currency collapse. Something that creates fear, urgency, and desperation for solutions. Stage 2. Panic and public demand. The crisis terrifies the population. People demand that the government do something, anything. They want stability. They want protection. They want someone to fix it. Stage 3. Private design. This is the hidden stage. While the public clamors for solutions, private bankers meet in private places and design the solution themselves. They write the legislation, they structure the institution, they ensure that the new system serves their interests while appearing to serve the public good. Stage 4. Government adoption. Politicians, desperate for any solution, adopt the banker's plan. They present it as reform. They market it as protection for ordinary people. They claim it will prevent future crises. The public, exhausted by fear, accepts it without scrutiny. Stage 5. Permanent extraction. The central bank begins operations. Government debt becomes permanent because the system requires it. Interest payments flow from taxpayers to bondholders forever. Wealth transfers from the many to the few, year after year, decade after decade, century after century. This pattern has repeated 3 times in 3 centuries. Let me prove it to you. We begin in England, 1694. King William III has a problem, a massive existential problem. England is at war with France. The 9 Years' War, also called King William's War, has been raging since 1688. Louis XIV of France is the most powerful monarch in Europe. His army is the largest, his treasury is the deepest, and he wants to restore the Catholic Stuart dynasty to the English throne. William III needs money to fight, but the English treasury is empty. The Crown owes money to every major lender in London. Tax revenue is already committed to existing debts. The goldsmiths and merchants who traditionally lent to the Crown are refusing further credit. William is, in practical terms, bankrupt, and he's losing a war. Stage 1. Crisis. The Crown cannot fund its war against France. Defeat would mean Catholic restoration, loss of Protestant succession, possible French invasion, and the end of everything William has built. This is existential. Stage 2. Panic and demand. Parliament is desperate. The Whig and Tory factions, normally at each other's throats, agree on one thing. They need money immediately. They've tried lotteries. They've tried additional taxes. Nothing generates enough revenue fast enough. They need a new solution. Stage 3. Private design. Enter William Paterson, a Scottish merchant and financial adventurer, with a radical proposal. He will organize a group of private investors to lend the government £1.2 million, an enormous sum, roughly 1.5% of England's entire GDP. In exchange, Paterson proposes something unprecedented. First, the investors will receive 8% interest annually, paid from customs duties, guaranteed by Parliament, forever. Second, And this is revolutionary. The government will never repay the principal. The £1.2 million will remain as permanent debt. The government will pay interest in perpetuity, but the loan itself will never come due. Third, the investors will be chartered as a new institution called the Governor and Company of the Bank of England. This bank will have the right to issue banknotes against the government's debt. These banknotes will circulate as money. Debt will become currency. Consider the genius of this design. The investors put up £1.2 million once. They receive £96,000 in interest every year, forever. That's an 8% annual return, guaranteed by the government in perpetuity. And the banknotes they issue create additional profit through lending. Stage 4. Government adoption. On July 27, 1694, Parliament passes the Tonnage Act, which includes the charter for the Bank of England. The subscription opens. Within 12 days, 1,268 investors contribute the full £1.2 million. The government receives its money. The investors receive their bank. Stage 5. Permanent extraction. And here is where the pattern locks in. That original £1.2 million debt was never repaid. Not in 1694, not in 1700, not ever. Instead, it was refinanced, rolled over, expanded. The government needed more money for more wars. The Bank of England provided it at interest. Each loan increased the permanent debt. Each loan generated more permanent interest payments. By 1720, just 26 years later, government debt had grown to £50 million. By the end of the Napoleonic Wars in 1815, it exceeded £850 million. By 1900, the debt had been paid down to around £700 million, but it never disappeared. Today, British government debt exceeds £2.5 trillion, and interest payments flow to bondholders continuously year after year, just as William Paterson designed 331 years ago. The Bank of England wasn't created to serve the public. It was created to fund a war and enrich private investors. The war ended. The investors kept their bank. And every British taxpayer since 1694 has paid interest on debt that can never be repaid. Now let's cross the Atlantic and jump forward 219 years. America, 1907. Same pattern. New nation. Stage 1. Crisis. The Panic of 1907 begins with an audacious scheme. F. Augustus Heinze and Charles W. Morse attempt to corner the stock of United Copper Company. They fail spectacularly. Heinze's brokerage collapses. The banks connected to Heinze and Morse face runs. Depositors want their money. Then the Knickerbocker Trust Company falls. Knickerbocker is the third largest trust company in New York with over 18,000 depositors. Its president had ties to the failed copper scheme. Rumors spread. Depositors panic. On October 22, 1907, over $8 million are withdrawn in 3 hours. Knickerbocker closes its doors, never to reopen. The panic spreads. Trust companies across New York face runs. The stock market crashes 50% from its peak. Banks stop lending to each other at any price. The call money rate, the rate for loans secured by stock, spikes from 6% to over 100%. Commerce freezes. Factories cannot get credit. Workers are laid off. The economy is seizing up, and there is no central bank, no Federal Reserve, no institution empowered to inject liquidity. There is only J.P. Morgan. Stage 2. Panic and public demand. The crisis terrifies the nation. Newspapers run headlines about bank failures. Depositors line up at banks nationwide. Congress demands action. The public demands protection. After the panic subsides, the consensus is clear. America needs a central institution to prevent future panics. Never again should the financial system depend on one elderly banker's willingness to intervene. Stage 3. Private design. And here is where the pattern becomes explicit. November 22, 1910. A private railroad car departs from Hoboken, New Jersey, bound for Georgia. Inside are 6 men who represent approximately 1/4 of the world's total wealth. They are traveling under assumed names. They have been told to arrive separately, to pretend not to know each other, and to use only first names during the journey. Their destination: Jekyll Island, a private resort off the Georgia coast owned by J.P. Morgan and a consortium of wealthy families. For 9 days, these 6 men will design the American central banking system. The participants: Senator Nelson Aldrich, chairman of the Senate Finance Committee and father-in-law to John D. Rockefeller, Jr., Abraham Piatt, Andrew, Assistant Secretary of the Treasury, Henry P. Davison, Senior Partner at J.P. Morgan Company, Charles D. Norton, President of Morgan's First National Bank of New York, Benjamin Strong, Head of Morgan's Bankers Trust Company, and Paul Warburg, Partner at Kuhn, Loeb and Company, and an expert on European central banking. These men were not government officials designing public policy. They were private bankers designing a system that would benefit private banks, and they knew that if the American public discovered what they were doing, the plan would be rejected. Americans had already destroyed 2 central banks, the first Bank of the United States in 1811 and the second bank in 1836. Andrew Jackson had called the second bank a hydra of corruption. Popular opinion despised centralized banking power. So the Jekyll Island participants worked in secret. They told no one what they were designing. They developed a plan, returned to the mainland, and began the process of making it law. Stage 4. Government adoption. The plan that emerged from Jekyll Island was called the Aldrich Plan. It proposed a central bank controlled by bankers. It was too obviously self-serving. It failed in Congress, so the plan was revised. The name was changed. Regional reserve banks were added to give the appearance of decentralization. Democratic politicians were recruited to support it, giving it bipartisan credibility. The bill was rebranded as the Federal Reserve Act. December 23, 1913. 2 days before Christmas. Congress is nearly empty. Many representatives have already left Washington for the holidays. The Federal Reserve Act passes the Senate 43 to 25 and the House 298 to 60. President Woodrow Wilson signs it that evening. The central bank that 6 private bankers designed on a private island was now the law of the land. Stage 5. Permanent extraction. And the extraction mechanism began immediately. Before the Federal Reserve, the United States occasionally borrowed money and occasionally repaid it. The national debt fluctuated. After wars, it typically decreased. The system could clear. After the Federal Reserve, debt became structural. Here is why. The Federal Reserve creates money by purchasing government bonds. The Treasury Department issues bonds to fund deficit spending. The Federal Reserve buys those bonds with money created from nothing. The government spends the money. The bonds remain on the Fed's balance sheet. The bonds accrue interest. That interest is paid from tax revenue. In effect, every dollar in circulation represents debt. Money is created through debt, and debt requires interest payments. Those interest payments flow from taxpayers to bondholders in perpetuity. In 1913, when the Federal Reserve was created, the national debt was $2.9 billion. By 1920, after World War I, it had grown to $26 billion. By 1945, after World War II, $260 billion. By 1980, $908 billion. By 2000, $5.6 trillion. By 2010, $13.5 trillion. By 2020, $27 trillion. Today, over $36 trillion. The debt has grown by a factor of 12,400 since the Federal Reserve was created, and the interest payments have grown proportionally. Today, the federal government pays nearly $1 trillion per year in interest alone. Not principal, just interest. That's more than the entire defense budget, more than Medicare, more than education, transportation, and veterans' benefits combined. Every dollar of that interest flows from American taxpayers to American bondholders, many of them institutions, many of them wealthy investors. This is the extraction phase. It has been operating for 111 years, and it will continue operating as long as the system exists. Now let's jump to Europe. Late 20th century, same pattern, third continent. Stage 1, crisis, September 1992. The European Exchange Rate Mechanism, or ERM, is under attack. The ERM was designed to stabilize European currencies before monetary union. Countries agreed to keep their exchange rates within narrow bands relative to each other. This would create stability, reduce transaction costs, and pave the way for a common currency. But the system had a vulnerability. Speculators could bet against currencies that seemed weak. And in September 1992, they did. George Soros, managing the Quantum Fund, concluded that the British pound was overvalued within the ERM. He began selling pounds short, betting billions that the currency would fall. Other speculators followed. The Bank of England tried to defend the pound. On a single day, Black Wednesday, September 16, 1992, the Bank of England spent an estimated £27 billion buying its own currency. It wasn't enough. That evening, Britain withdrew from the ERM. The pound crashed. Italy followed soon after. The carefully constructed system of currency coordination was in ruins. Stage 2. Panic and demand. European leaders were shaken. The ERM crisis demonstrated that national currencies were vulnerable to speculative attack. Individual countries couldn't defend themselves against global capital flows. The fear spread. If currencies could be attacked, the entire European project was at risk. The solution, according to European technocrats, was to eliminate national currencies entirely. A single European currency, managed by a single European central bank, would be immune to the kind of speculation that destroyed the ERM. There would be no exchange rates to attack. The currency would be stable by design. Stage 3. Private design. The European Central Bank was designed in committee rooms in Maastricht, Frankfurt, and Brussels over several years. The designers were central bankers, finance ministry officials, academic economists, and representatives of the banking industry. They modeled the ECB on the German Bundesbank, which was considered the gold standard of central banking, independent, technocratic, focused exclusively on price stability, and insulated from democratic pressure. The ECB was designed to be more independent than any central bank in history. By treaty, the ECB cannot take instructions from national governments. It cannot be ordered to fund deficits. It cannot be audited by national parliaments. Its governing council members serve 8-year terms and cannot be removed. The ECB answers to no electorate anywhere. This wasn't an accident. It was intentional. The designers believed that monetary policy was too important to be subject to democratic pressure. They believed that politicians would always choose short-term inflation over long-term stability, so they created an institution beyond political reach. Stage 4. Government adoption. The Maastricht Treaty of 1992 established the legal framework for the ECB and the euro. The ECB was officially established on June 1, 1998, in Frankfurt, Germany. The euro was launched as an electronic currency on January 1, 1999, and as physical cash on January 1, 2002. 19 nations surrendered their monetary sovereignty to this new institution. They gave up the ability to print their own money, to set their own interest rates, to devalue their currencies in response to crisis. They trusted the ECB to manage their money better than they could manage it themselves. Stage 5. Permanent extraction, and then came the European debt crisis. Beginning in 2010, Greece, Ireland, Portugal, Spain, and Cyprus all faced sovereign debt crises. They had borrowed heavily, often with the encouragement of European banks flush with cheap euros. When the 2008 global financial crisis hit, their debts became unmanageable. The ECB's response revealed the true nature of the system. The bailouts that followed were not bailouts of countries. They were bailouts of banks. When Greece couldn't pay its debts, the troika of the ECB, the European Commission, and the IMF provided emergency loans. But those loans didn't go to Greek hospitals or Greek pensioners. They went to repay French and German banks that held Greek government bonds. The private creditors were made whole. The losses were transferred to Greek taxpayers through austerity measures, pension cuts, wage cuts, public asset sales, healthcare reductions. The pattern repeated. Private debt became public obligation. Banks kept their profits from the lending boom. Taxpayers absorbed the losses when the boom ended. The ECB's balance sheet has grown from less than 1 trillion euros in 2007 to a peak of 8 trillion euros in 2022. Today, it stands at approximately 4.9 trillion euros. These are assets purchased with created money. Government bonds, corporate bonds, claims on the productivity of 340 million European citizens, 3 central banks, 3 continents, 3 centuries, the same 5-stage pattern: crisis, panic, private design, government adoption, permanent extraction. This isn't coincidence, this is the template. Now you might say, that was history. Those were different times. The system has evolved. We've learned from our mistakes. Let me show you that the pattern is operating right now, today, in the response to the 2008 financial crisis and its aftermath. Stage 1. Crisis. September 15, 2008. Lehman Brothers files for bankruptcy. AIG collapses. Credit markets freeze. The global financial system teeters on the edge of total collapse. Stage 2. Panic and public demand. Too big to fail becomes the mantra. The public is told that if the banks collapse, everything collapses. ATMs will stop working. Paychecks won't clear. The economy will implode. Terrified citizens demand that the government do something. Stage 3. Private design. Who designed the response to the 2008 crisis? Treasury Secretary Henry Paulson, former CEO of Goldman Sachs. New York Federal Reserve President Timothy Geithner, who would become Treasury Secretary. They worked with executives from the very banks being rescued. The solutions were designed by Wall Street for Wall Street. Stage 4. Government adoption. Congress passes the Emergency Economic Stabilization Act, creating TARP, the Troubled Asset Relief Program. $700 billion authorized to purchase troubled assets. The Federal Reserve provides over $16 trillion in emergency lending to financial institutions worldwide. Trillions created from nothing to save the system that bankers built. Stage 5. Permanent extraction. And this is where we are now. The Federal Reserve's balance sheet has grown from $900 billion in 2008 to over $7 trillion today. That's a 700% increase. Every dollar of that represents assets purchased with created money. Every dollar represents a claim on future American productivity. Interest rates were held near zero for over a decade, forcing savers to accept virtually no return on their savings, while asset prices, stocks, real estate, inflated dramatically. Who benefited? Asset owners. Stock prices rose from a low of 666 on the S&P, 500 in March 2009 to over 5,000 today. A 650% increase. Real estate prices doubled in many markets. The top 10% of Americans, who own 93% of stocks, captured virtually all of these gains. Who suffered? Savers, workers, young people trying to buy homes, anyone who relied on wages rather than assets, and the interest payments continue. The federal government now pays nearly $1.1 trillion per year in interest on the national debt. That's more than it spends on the entire military, and the debt is growing. By 2030, interest payments are projected to reach $1.5 trillion. By 2040, potentially $2 trillion per year. Every dollar of that interest flows from taxpayers to bondholders, permanently. This is stage 5. This is extraction, and it doesn't end. The pattern that created the Bank of England in 1694 is operating right now, in 2025, extracting wealth from American taxpayers exactly as it extracted wealth from British subjects 331 years ago. This is not a conspiracy theory. The Bank of England's founding charter is public record. The Jekyll Island meeting is documented by its participants. The Maastricht Treaty is available online. The Federal Reserve's ownership structure is published. The balance sheets are quarterly reports. The pattern is documented history. Crisis creates opportunity. Panic creates demand. Private interests design solutions that serve private interests. Governments adopt them. And extraction continues forever. It's not a conspiracy. It's a business model, and it's worked for 331 years. The system isn't broken. It's working exactly as designed. Designed by private bankers, adopted by governments, paid for by you. If this opened your eyes, if you finally understand why central banks exist and who they serve, subscribe. Because understanding the pattern is the first step. The answers aren't hiding in the future. They're written in the past, and once you see the pattern, you cannot unsee it.